This is the week of April the 8th, 2013. This is Michael Can speaking. This is our market commentary. Last week, markets suffered a setback due to weak employment figures and North Korea's fighting words. Added to the Cyprus issues, and the market has given back all of its year-to-date gains in Canada and a good deal of its U.S. gains too. My last call noted how difficult the equity markets have been recently. In fact, over the last 13 years. And I stated that historically this sideways action was not unusual. The following chart shows numerous periods in which the market moved sideways for a decade or longer. During these periods, only dividends and successful frequent traders drove portfolios higher. But historically, the following up leg, when markets probe to new highs, can be very significant. So, could we be close to the end of the current market sideways move? Absolutely, and for three primary reasons. Valuations are fair, and as a matter of fact, in 2007 at the previous S&P 500 high, the market had $84 in earnings and the 10-year treasury yields were 4.3%, while now the S&P's earnings are $112 and the 10-year yields are only 1.8%. Further, current PE ratios are in around the 13 times range, while historically PE ratios have been in the mid-teens. Second, interest rates are so low that investors have limited choices. Further, many investors have moved to the sidelines, so a mountain of cash continues to look for a long-term home. I believe that money will absolutely continue moving slowly back to find itself in the equity markets, particularly as dividend yields are 1.5% to 2% higher than current 10-year bond yields. And last but not least, irrespective of last week's weak U.S. figures in the economy is slowly improving as U.S. housing improves, fuel prices ease, the U.S. consumer stabilizes, and pent-up demand rises. Further, governments around the world continue to stimulate their economies and provide cheap credit to markets. Am I alone in this optimism? Absolutely not. Recently, former U.S. Fed Chairman Alan Greenspan was interviewed on CNN as markets pushed towards new highs in March. He was asked if this market move was irrational exuberance, as he said, absolutely not. In fact, markets were the opposite of his famous 1996 expression, and he felt equity markets continued to have plenty of room to improve. I don't expect that we are through all the global issues and still expect markets to be volatile. But that said, equity markets offer very fair risk-reward. When one considers that markets tend to climb a wall of worry, it's fair to be optimistic that a break from the sideways cycle could end and give rise to a surprising upleg as market behavior changes. That's it for this week. We thank you for listening and wish you and your family well.